2017 has witnessed quite a rally in asset prices, be that on the equity side or on the fixed income side. We've seen a rally in spreads in credit products such as high yield, US investment grade, as well as emerging markets. However, when we look across the globe and we look at different sectors of fixed income, we still find EM to offer very compelling yields compared to other sectors. Emerging markets allow you to get a yield of between 5 and 6.5%, some of it in dollars, some of it in local currencies. In fact, on a 6-month horizon, we believe that local emerging market debt, the one denominated in local currency, has the potential to generate the most significant returns for investors. With regards to flows, we've seen a lot of money coming back to emerging markets. But what we find is that investors, both retail and institutional, remain quite underweight structurally to emerging markets. We think they will gradually close the gap, but it's important to remember that by being underweight emerging markets, there is a high opportunity cost because of the high yield on offer, significant spread and yield on offer in emerging markets. With regards to our portfolios, we're trying to position carefully, given that there's still some uncertainty around the protectionist rhetoric of the Trump administration. Although we think the risk has significantly diminished year to date, we're still trying to be more active and more overweight in countries like Argentina and Brazil that are less exposed to US trade and tend more, frankly, to trade with each other. We're also avoiding countries that offer very little spread, very little yield. In many cases, these are countries such as the Philippines and some of the other Southeast Asian countries where, by virtue of technicals or local demand, they trade at spreads that don't compensate us for the risk associated with holding those names. Obviously, given all the geopolitical risk, we've also sold quite a lot of our asset holdings in places like South Korea.